All right, it looks like we have a few more jumping on, so we'll get started in just a moment. All right, well, welcome to our webinar entitled Knowing and Growing Your Value Through Valuations as a Service. My name is Aaron Mahl, Executive Vice President here at iTValuations, and I'm joined today by Greg Northrop, our Director of Tax and Finance, as well as our CEO, Reed Warren. Great to have you both here today. A couple of housekeeping items before we get started. You can feel free to use the Q&A feature in the chat. We may not get to all the questions that are asked during the webinar, but we will spend the last few minutes or so addressing the questions we have. And if we have time, we'll deal with as many as we possibly can. Second, this webinar is being recorded, and so we will send out a link to the recording shortly after that is completed today. Reed, why not start with a brief, maybe personal introduction of yourself and also ITV, and then we'll have Greg introduce himself.
Yeah, thanks so much. And thanks, Aaron, for helping to pull this all together. Just super excited about today. This has been long in coming. Last 15 years, I've spent doing valuations, mergers, and acquisitions of IT services in North America. And so much of what led to the inception of IT Valuations was this understanding as we put together transactions, people would want a valuation done, and then we get into the valuation, and we couldn't get the banks to support it because the valuation didn't support the transaction. So came back, and as IT Valuations, we became certified valuation analysts through NACFA, which is the National Association of Certified Valuations and Analysts. And we're members of that, one of two governing boards that kind of govern the valuation process. But one of the things and so valuations became a backbone to just about everything we do. So whether it was business strategy or selling the business or possibly buying businesses or merging companies, all of it's predicated upon a good fundamental understanding of what goes into valuations. And so we'd have sellers that would come to us and say, hey, I want to sell the business, and we do the valuation. And as a part of that journey, we're able to identify things that they could remediate within the business and really improve the value. And so as we launched into that, they'd come back a year later going, hey, I fixed some stuff, and they'd find out we do another valuation. There's just more things. And so as we launch into this valuation of service, so much of what's born in this subscription offering is this way to keep value as a front and center, so that you're always working away towards really making sure that you're optimizing the value of your business for whatever you're trying to do, whether it's transactions or bank financing or estate planning. Even good business strategies is going to be all predicated upon what's your starting point as you get into it. And so super excited about that. I've spent my whole career in the technology space going back to the early 90s, and it's just been fun to see this come to fruition and be able to take this to the market in a way that really equips buyers, sellers to really wrap their arms around the value of the business and make sure that you're not overpaying or if you're the buyer and not being taken advantage of as a seller.
Great. Greg.
Yeah, Greg Northrop. Had the pleasure of joining the IT Valuations team back in September of last year. Spent the first 9 years of my career working in public accounting as a CPA, working with high net worth individuals, doing gift and estate tax planning, as well as just a lot of mergers and acquisitions for those like larger high net worth families and their family businesses. And so kind of bring a variety of background and experiences with me from a tax and finance side of things, and really head up valuations here at IT Valuations. Since I joined, I was basically handed this idea that Reed and the team had come up with of valuations as a service, and basically said, hey, here's something that we want to do. We already have kind of a template in mind. Can you work with a developer and go build it? And so this has been a, call it 9-month journey of really diving into the industry, really getting saturated with what's going on, of what drives value, what's driving transactions in the marketplace, and then really putting it in a utilizable tool and dashboard that actually drives change in value creation in businesses. And so excited to be with you here today to help kind of showcase that and answer any questions people have, and really want to be a resource in the marketplace.
Thanks, Greg. Both Greg and Reed are located at ITV World Headquarters, St. Paul, Minnesota. But I am in a dark hotel room in Cooperstown, New York, at a Holiday Inn, just living my best life at my son's baseball tournament. And since it's summer and it's baseball season and baseball is in full swing, I thought we could start with a trivia question, and that the winner of the answer to this question gets a $50 Amazon gift card. So this is a chance for you to engage in the Q&A section. But if you can name my favorite baseball team, we will go ahead and give you an Amazon gift card for $50. Go ahead and put that in the Q&A chat. We'll let you know at the end of the webinar if you won or not. So $50 gift card. Here's the only clue I'll give you. They won last night. So that eliminates half the teams probably who lost. And so keep that in mind. So before we get started, I want to launch an anonymous poll, and just to get a sense of where folks are at maybe on this webinar. And that is, what is your timeline for a transaction? Maybe you're buying, maybe you're a buyer, a strategic buyer, maybe you're a seller. What is your transaction? Maybe the LOI is already signed, or one of our coworkers, Garth, always says that an LOI is not a tattoo. Okay, that's true. Maybe you're within 12 months, you're thinking of buying or selling 2 to 5 years or more than 5 years. So why don't you go ahead and fill out, if you can, that poll, and we'll take a quick look at the results.
Well, while they're doing that, can Greg and I vote on, what your favorite baseball team is, or are we excluded?
No, you cannot. You cannot, because we cannot have an ITV employee win win the $50 gift card. It looks like right now we're seeing it really. I don't know if you can see the poll in real time, guys, but we're seeing about 53% are saying within 12 months. And the LOI already signed is 18%, and 2 to 5 years is at 29%. I think we had a question around whether or not it was an MLB or college team. MLB. That's a good clarification. If it was college, we'd all know it was University of Tennessee, right? Who won the national championship last night. So not college, not college. So, all right, let's close out the poll for now, and let's get started, because you weren't here to talk about baseball. So Reed, we're halfway through 2024. What are you seeing on the M&A front really related to transaction velocity and multiples?
Yeah, this has been just such a fascinating year. Yes, last year was a really strong year, and I would say the velocity has certainly continued well into this year, especially as what we're seeing on that whole journey. At the same time, I would say we're continuing to see kind of multiples erode. And I don't want to say, like it's just going negative. They're really kind of retracing. We were at such a bubble, and I think the peak of that bubble was summer, June-ish of 2022, and we've just seen both valuations and transactions sort of retrace back to more normal levels, although it's still well above what it was pre-COVID. So, as we look at the rest of this year, I anticipate a pretty strong year, but we're probably seeing the retracing more at the larger transactions, and certainly probably the most of some of the smaller transactions. And by smaller transactions, we're looking at firms that are typically less than 500,000 in EBITDA. They've probably retraced the furthest, and a lot of that has to do with just interest rates, and interest rates continue to stay high. We'd had some hopes that interest rates would come back a little bit further this year and lower, which we'd expect to infuse some energy back into the market. But again, the private equity space continues to be strong, although they're continuing to get more cautious. And so that we're not seeing some of the wilder multiples that we saw at the end of 22 and early 2023. But continues to be a strong market if you're looking to sell, very competitive if you're looking to buy.
Greg, you're in the Valuation as a Service, or VaaS platform daily. I'm curious, from your perspective, what are companies struggling with most in relation to value creation?
Honestly, they're just struggling with how to track it. There's been just such a emphasis on EBITDA and EBITDA multiples in the marketplace that if I drive higher EBITDA, I'm going to drive a higher value. And I'm not saying that statement is wrong, but there's more that goes into value than just what is your, net cash flow of the business. There's a bunch of different things that you have maybe more control of than just EBITDA that you can be focusing on, and be kind of, in some ways, it's the lower hanging fruit that you can take advantage of and get cleared out of the way, so that it makes due diligence smoother. It makes you be able to command a higher multiple, that, the transaction isn't just focused on EBITDA either. The transaction is looking, holistically at the entity and the organization. So then when you're approaching your value creation and approaching how do I measure my value, we want to approach it that same way, that there's more to it than just that one number on a piece of paper.
Yeah, we use the phrase more than a multiple quite a bit at ITV, that your business is more than just applying a multiple to a EBITDA number, right? And so, yeah, I think that's important. Reed, as you talk to possible buyers about the firms sometimes that we're representing, sometimes we're representing the buyers, what's most attractive to them, the buyers, and what performance metrics are you seeing driving the highest multiples in the current market?
Yeah, I would, again, coming back to it being more than a multiple, right? A lot of people are looking at, there's a number of industry reports out there that show where transactions occur, but from a buyer's perspective, it's really about return on investment. And so it doesn't really matter what the multiple is that you're paying for the seller. It's really more concerning about what's my return on my investment. And so a typical firm, when we do buy side work, we're typically trying to get for the buyer somewhere between 20 at the low end to ideally 25% or even as high as 30% internal rate of return. If you translate that back into a multiple, that's like a 5x at the highest and a 3x at the best for the buyer. Well, most sellers aren't selling for those numbers. And so what we really have to look at is how are we going to get to that internal rate of return, which means something has to change within the seller's business to be able to justify paying an 8x or a 9x in the transaction. How do you do that? The number one way is through accelerated growth. So when you're growing at twice the industry growth rate, that's a great example of, okay, you have a good sales organization, you have a high value proposition, you're able to put new logos on the board. Some of the highest multiples that we've seen have been for companies that have better than twice the market growth rate. And I would say the market's been growing somewhere around 10 to 12% year over year for the last 3 years running since COVID. We've had a strong market. And so we have a lot of sellers come into the market today going, hey, I've been growing really well. I've been doing 10% growth. And it's like, well, at 10%, you're staying afloat. You really aren't taking ground or taking market. And so love to see those companies that actually have a good value proposition growing, ideally closer to that 20 to 25% top line. Says a lot about the business and the ability to be able to take market. And then there's a number of other things, and Greg's going to weigh in on these as we get into it, that really start to look at some of those other things, your cash flows, your ARs, your APs, your owner dependencies, customer concentration, recurring revenue. I mean, there's a lot of factors that really come into what is the value of your business, and it creates this kind of risk profile. And so as much as people want to, sellers want to apply a number to their EBIT and say, well, this is what the average is. Every buyer looks at all of these factors and says, I've got to look at all these risks in context to the purchase price that I'm going to apply for this business. And what we've done since we'll do 11 to 15 transactions this year. As a part of that, every buyer looks at all these different pieces and say, okay, as a result, I can only pay so much for this business based upon all these risks that are inherent in the business. And so what we've been able to put into valuations as a service is all these calculations from this experience that we've had of helping businesses transact to be able to come up with real levers that can be really pulled to really align to your company specific risk and the corresponding value associated with it.
Yeah, growth is key, right? Vital for sure. Buyers want growing companies. Greg, any other metrics that you see that are attractive to buyers right now?
Well, I just want to echo the growth one because sometimes it can feel counterintuitive. Again, with that, if the focus is EBITDA, a lot of times it takes an investment of, building out a sales organization, which is adding more overhead, and you may not necessarily see that return on that investment right away, where you're not actually driving that higher growth rate, immediately upon hiring that salesperson or building out that sales team. But the companies that have that sales engine built up, we are seeing a higher, return on that investment, a higher multiple. Again, if you build it out now in advance of selling down the road, not only will you have that growth rate that you've then been able to generate for period over period, quarter over quarter, but you're also then potentially getting to a place where you've grown it to a size and a scale that you're actually starting to reap the benefits from an EBITDA perspective, because you're growing potentially the service line or service offering that has the greatest gross margin, which therefore has the greatest impact on your EBITDA. And so what happens with some businesses that we're seeing with, and this is what's fun about the tool, is we're able to actually break down each of your revenue streams and to be able to see what is the growth rate and the gross margin of each of your revenue streams. And you might already have that in other tools as well. But now let's project that out on a forecasting basis, because as that revenue mix changes, so does your profitability of your business. So much people look at EBITDA as I need to control my costs. But if I actually focus on growth and growing the right service offerings with the greatest level of profitability, that in turn is going to have a reciprocal effect on EBITDA. And therefore, not only are you a growing organization, you also have a growing EBITDA organization, which that essentially puts you in the best in class companies that we see from a valuation perspective.
Yeah, and I
Yeah,
would
what I
just
mean,
echo on that, just that, it's really kind of unmanipulated financial data, when you
mhm.
look at what a buyer wants. So the reason why every private equity firm does a quality of earnings is they fundamentally typically don't believe what the seller's providing them from financial data perspective. And it's not that the seller's trying to misrepresent pieces, but the reality is because there's not really good financial tracking, I can't really figure out what your gross margins are because you don't have things allocated right, which means you're manipulating data now to come up with your gross margins, to come up with uh, your true cost of goods sold, those different elements to it. And so much of what a buyer really wants to see is to be able to look at your financials and actually see your story of good organic growth, of good business health, of making right operational decisions. All of that at some shape or form comes back to your financials. And so your ability to be able to articulate the efficiencies of your business, your rigor in service delivery and sales growth and return on investment in marketing, all of these things will be seen in your financials, and having your financials be able to tell that story rather than you having to explain what's in your financials because it's not there. And so the number two piece behind that, when you look at what buyers want, is highly articulate financial story and narrative that can be seen, and not an explanation for all the anomalies that are there.
Yeah, I think, one thing when we talked about valuations as a service, or when you talked to me about it a while back for the first time, you talked about how knowledge is so important for business owners that every decision they make either increases or decreases the value of their business. And as a
Yeah.
business owner, as yourself, you know that, right, from firsthand experience. So I guess talk about valuations as a service, because this is the idea was in essence born. These, annual valuation, 3 quarterly updates. Talk about the genesis of that and kind of where it came from.
Well, I think it's the genesis behind it was it's sort of like trying to lose weight without having a scale. If you stepped on the scale once a month, it's like, well, it's a good data point, but it doesn't help me day to day make decisions, right? And so what we saw from a valuation perspective is people would come, they do a valuation, and the normative, candidly, most people don't do valuations candidly more frequently than once a year. But once a year is just too far apart for really being able to dial in, hey, these different value drivers and make sure that I'm actually really pulling these levers. And so it'd be like just like similar to saying, hey, we just do strategic planning once a year. We get together, we do our plan, and then we put it on a shelf and we kind of go out to work and we check ourselves at the end of the year and go, did we accomplish it? Well, maybe you did, maybe you didn't, but because there's not good feedback, you don't know how you're doing on that progress. And so we'd have people come to us and have regular valuations, sort of like an annual physical. And it was like, hey, this gives us good data. But because the data points are so far apart, people weren't taking advantage of the time. And quite candidly, time's the only commodity you can't get back. And so you spend a year, and if you wasted 3 quarters of the year by not looking at pieces, well, you can't like go get a redo. You have to take the next 3 quarters to do that. And so as we found, as we moved to getting, we were doing these verbally where people do an annual valuation and they go, okay, here's my new numbers. Can you kind of quick take a look at this? And so then, for us, it really is having this really consistent structure and methodology to be able to actually track quarter on quarter value creation and see how you're transforming the business quarter on quarter. We found that companies, when we ran the beta program that did that, because they were getting real time, quarterly data around it, they were making much more effective decisions because they could see how levers were being pulled and they could acknowledge, hey, we had this dip because we made this investment. We're going to continue to make this investment, and then we're going to see how things transform. And candidly, if we're not seeing the transformation, hey, then we need to pull back on the expenses. So it just it's like, I'm a pilot. I love flying. It's like trying to fly without gauges. It's like, well, I can fly along and look out the window, but if things get cloudy, man, that's a really dangerous place to be as a pilot. What we really try to do with valuations and services is articulate these 24 different values so that you have this dashboard of good data endpoints, more than just what's out there in the marketplace. There's great tools in the marketplace for operational maturity. There's great tools in the marketplace for the financial analysis piece. this is really, I think, the first tool that really looks at all of these different elements that says, how effective is your marketing? How effective is your sales? How effective is your delivery of service? How effectively is your financials? How effective are your contracts? What kind of dependencies, all these things that come into it, and now provides this dashboard that says, hey, now I can actually start to pull some of these levers in a much smaller way to get you to the optimum value of the business and all those things that you're going to need to consider either as a seller or as a buyer, and determining what is the fair value for the business.
So the idea is born, Greg, but now it's time to build it, right? So I think
that's why I
think
hired Greg, because I just came up with the idea, say, hey, Greg, here's a big problem. We need to solve it. I have some ideas. And
Yeah.
Greg, I mean, truly love the fact that Greg came in, especially with all the tax background, and because in the end, all this stuff also impacts tax. It also impacts tax is the number one impact on the transaction proceeds that came to it. And so Greg really with that CPA and tax background and transaction background from a tax perspective was able to really masterfully create this tool and along with the software development team that we put together to build it.
Right. I think, I think we kind of have a sense of the problems it was trying to solve. Greg, maybe talk about the results you've seen thus far, and I'll advance the slide to let maybe those of us who are more visual learners begin to get a taste of just what it may be like from a user experience.
Yeah, no, thank you. Reed, you're too kind. But yeah, we had a vision and we had an end goal in mind. And the vision and the end goal were aligned in the sense that we wanted to provide something that was valuable with useful information that actually gave you actionable steps and recommendations as to what you can do within your business today to derive more value. And so the whole point of, and Reed touched on this, like the whole point of a one-time valuation is you get a snapshot into the value of your company at that one point in time. And some valuators may or may not actually give you some of the drivers that went into that calculation or some things that you can actually do to input, like change it. So this is really meant to be a guide and a tool for you to look at, okay, here's where I was at last quarter. Here's maybe my couple of things I can go out and do this quarter, because you can't tackle all 24 of these factors in one quarter or 1 year. You kind of have to pick and choose what are the ones I'm going to address this quarter, next quarter, or this year, and really focus on those. And then you can get to see as you're making progress with those, the reciprocal effect on your valuation. And so what the user experience is like is it's really meant to bring all of those metrics and all of these calculations into one place with our dashboard, where you can see all those valuations quarter over quarter on one kind of graph. You can highlight over different points on that graph to kind of see what was the trajectory last quarter versus the trajectory I'm on this quarter, and compare them to say, hey, this is actually, I'm on track to hit that goal or objective, because based on where I set my forecast, I'm actually on track, like in this example you're seeing here, that this $12 million company was on track to be an $18 million company a year later. And now you can actually use this tool as a guidepost rather than, like Reed use the analogy of a pilot, rather than flying blindly and saying, I want to be a $20 million company, go do it. You actually now have a guidepost and like bumpers and metrics to value yourself and measure yourself by, in order, like all along that journey, to make sure that you accomplish that goal or objective of hitting that dollar amount. The other component with this is, a lot of business owners I talk to, they maybe have a number in mind, whether it's a personal wealth target, an exit point target, or maybe it's a retirement age target. It's less about the dollar monetary value. It's more about an age or a date and time. And what this tool can also help you do is march towards that date, march towards that number all along the journey, that you actually now have a concrete way of how to measure where you're at as you approach that number, how close or how far away, how long is it going to take you to get there? And then you have a resource with our team that does, buy and sell side work as well, that we're in the marketplace, we're attuned to what's going on. These valuations are updated every quarter. We are working on the tool and the modelization, so it's up to date with real market data of what we're seeing in the marketplace. So if multiples are changing in the marketplace, the tool is being updated every quarter to reflect that. So you're getting an accurate, in real time, a calculation as to, if you were to go to market today, this would be kind of the approximate valuation of where we would kind of see that starting point be from a hypothetical buyer standpoint. And not to mention these valuation scores you're seeing, you're going to get the level of detail of what is best in class, what is kind of middle of the road, where would maybe I be struggling. And there's going to be recommendations on your dashboard that actually guide you of, hey, if you're struggling in this area, here are some things that you could do. This is things that we've seen other companies do that would be deemed more best in class, top quartile, using kind of the SLI language of these are what those companies are doing that you can maybe implement in your business to really right size or uplift that one value driver that's maybe a little bit lower. And then next quarter, we can see the uptick or the change. So what you're going to be able to see here in Q2 and beyond, we're continuously making updates to this app. But in Q2 and beyond, you'll be able to click into each of the valuation scores and see a graph of how you've actually increased or changed your valuation scores each and every quarter. So you can track your progress. So what we've seen companies utilize this for is not only for their own like metrics and analysis as an owner, but even for their leadership team, their management team, or other leaders within their organization to be like, hey, like if you're in charge, if I have someone in charge of my contracts, like our contract score is low. Here's some recommendations of things we can do to change our contracts. You're already working with our attorneys to get the contracts updated. Here are maybe some points that we can look to do to increase our contracts, make sure that they're transferable upon a sale, make sure we have, yearly increases if it's a multi-year contract. And so there's different things that you can be doing now that you can empower your leadership team and other people in the organization versus just, continuing on a dashboard to look at. It actually is going to drive actionable change.
Well, and one of the cool things that I love about this slide is when we do the first valuation, it's not a single point in time. We're actually doing 5 valuations in what you're seeing here because we go back and do a valuation for each of the previous, basically 5 quarters, because we want to be able to see that trend line. Obviously, when we look at kind of valuation methodology, in short, a lot of what we're looking at is what is the present day value of the historic cash flows and what is the present day value of the future cash flows based upon assumptions around growth and profitability, your historic trend lines, and a lot of those different pieces that come together. And I don't want to get in the weeds of the valuation analysis that we do, but a lot of this stuff, as we look at, continue to move forward, it is around one of the other things buyers love is good, predictable profitability and growth, your ability to be able to hit those targets. And so for you, as you get into doing good budgeting and kind of fiscal rigor, this also provides some of that clarity to go say, hey, what did I forecast my growth to be, last quarter? Where did we hit compared to what we budgeted and forecast? Where were we over a year ago? And so it gives a lot of these kind of metrics that you can start to look at that build some of that great financial rigor, as well as you being able to, monitor those and be able to match those. Not only from a historical perspective, but then also into a helping you become better at actually budgeting and forecasting.
Oh, that's really good. I think, Greg, one of the things I was thinking about too is when we started talking to folks about this, the strategic, I mean, the why is obvious. It's knowledge, it's power, it's decision making, it's strategy, and it makes you a stronger company. But sometimes these tools can be a little bit of a lift from a client perspective. And financial data, there's a lot of data, a lot of Excels, spreadsheets, a lot of lines and rows and columns. And maybe some people on this call, Greg, love that stuff. Maybe others on the call not so much. So talk about how we designed, I guess, the solution to make it as light a lift as possible, because the reality is there's a lot of data that we're mining through to help discern and find value, right?
Yeah. If anyone on the call has either gone through a transaction, either have sold or have bought another company, you know that it's a spreadsheet nightmare a lot of times where you're combing through spreadsheets to try and see all the information you need during due diligence. And, to some degree, the old school way of doing valuations was no different. We had our kind of due diligence list of here's all the spreadsheets and all the financial data we need in order to do the valuation. And truthfully, the time it would take an owner potentially to get us that information, it would take them, 10, 15, even 20 hours in certain cases, depending on how many add backs they had and how much they had to dig into their information, how familiar they were with pulling the reports, if they had a, good financial platform to pull the reports from, or if the reports were ready to go. And that was a very cumbersome process. And we just saw a lot of delays in our valuation engagements where companies would sign up and it would take them a month to get us the information. Obviously, they're still trying to run their business amidst trying to get us the information. So now what we did with the tool is we integrated it with, as of today, QuickBooks Online and QuickBooks On-Prem or desktop. And so it will automatically link with either of those two accounting systems today, where essentially you just enter your username and password, for an online, or it links directly to the desktop version on your computer if you're using on-prem, and it will extract the data that it needs in order to do the valuation. And all you're doing then is going through and classifying what are the different types of, revenue streams, what's your projected forecast and growth, what are your owner add backs or normalizations. But everything is basically pre-populated using AI and using the combing through the QuickBooks reports that are pretty standard of what's income, expenses, COGS. I mean, you have the ability to move things around, but you don't have, it really lightens the lift on your end because all the data is already there. So all you're doing then is basically flipping a couple switches here or there, entering a couple numbers, and we've seen that time get cut down dramatically, where we've seen companies get through this, lift or upload information process in, less than 2-3 hours. So it really has completely streamlined that process. And not to mention, when you go forward on a quarter over quarter basis, the process gets even simpler because all of the questions you answered that first time through are pre-populated for the next quarter. So you only have to go through them if there's any changes to those questions. Your preferences for how you organize or classified your accounts only have to be updated if there's any changes to them. So potentially, if your chart of accounts didn't change, your forecast didn't change, your questions didn't change, you could potentially do one of the quarterly updates in less than 15 minutes. And so that's kind of the value proposition that we're deriving here is we understand that time is money for everyone. Like, we don't need, it's not scientific, right? So if we can save you time on getting this information, that makes this information even more valuable to you because you're not spending, all this additional time and lift to get this data at your fingertips.
That's great. For those who've jumped on a little bit late, a couple quick notes. You can use the Q&A section in the app to ask some questions you may have. Secondly, I'm in a hotel in Cooperstown at a baseball tournament, so we offered a $50 gift card if anyone could discern who is my favorite MLB baseball team. And as of now, no one has correctly guessed. The hint was they won last night, and I'll give you a second hint. It's in the American League. So there's your hint. A couple more questions before you jump to the audience questions. So you can use the chat feature or the Q&A feature, by the way. I guess, we did a poll as the webinar was starting. We asked what the timeline was for a transaction, and about 52% said within 12 months, and about 28% said within 2 to 5 years. So maybe, Reed, if they answer within 12 months, is VaaS a good solution for them? And then I'll ask the same question to Greg for those who answer within 2 to 5 years.
Yeah, certainly within 12 months. I think when you come into the transaction, there's not, people think about selling their house. I can go out to Zillow and I can see kind of, hey, what the value of my house is. There isn't such a thing for businesses and business transactions. And even you can get some at some really high level macro, like technology as a whole. But when it comes down to really the specifics of IT services, specifically MSPs or the likes, they're just not that good data that is out there that takes a look at it. So if you're looking at selling within the next 12 months, this becomes a valuable tool because we find, like you said, 2/3 of our sellers that come to us thinking they're ready. And then when they go through the valuation process, they go, man, I mean, seriously, we're working with one right now that went through the process, started the conversation, decided to hold off for 6 months because they could literally add $4 million of value to their business in 6 months by remediating some of these things. So it's not like all this stuff takes, decades to be able to work on. That said, you typically do want to start 2 to 3 years in advance of when you want to sell to get things in order to be able to do it in a timely fashion. But even then, if you're looking at it going, hey, I'm just ready to sell and it is what it is, hey, having a good understanding of what your sale price is or what the market's going to bear is going to make sure that you're, there's so many people today, there's so few sellers that are out there, so many buyers. You have a lot of people kicking tires looking for sellers that actually are just ignorant about their value and taking advantage of that. And so for you as a seller, I can't think of a more, I mean, you'll easily get 10 to maybe 100 times literally the value out of this service which is $700 a month. And I'm not trying to jump ahead to it, but it's a really small price compared to what you can glean out of it and making sure that you're getting a fair price for your business.
Mm-hmm.
Anything to add, Greg, for those 2 to 5 years out by our sellers?
Well, the reality with sellers from 2 to 5 years out, they might have a merger or an acquisition along the way before they sell, that you would want to know, what is the value of my business and am I on pace to hit my wealth target or what am I going to be on pace to hit 2 to 5 years from now? So if you get on VaaS now, you can kind of start to establish what does that target look like? What does that roadmap look like to get there? And can I get there on my own? And if the answer is no, you can now start those merger or acquisition conversations sooner rather than later so that you can get the lift in your organization that you need to ultimately position yourself to accomplish your goals and objectives. So that's, again, really to really say it frankly, this tool is meant to help you accomplish your goals and objectives when it comes to value creation and exiting at some point.
Well, and I think that so many people are using, so many of our clients and so many of the Evolve community, especially, I mean, there's almost all of the communities are using EOS. This becomes such a great way with quarterly rocks to be able to go to your team and just say for your sales team, hey, how do I actually put quarterly rocks into place for my sales team that's going to drive up the sales activity and maturity? What do I need out of my financial team to be able to get financial maturity? What do I need out of my delivery team? And so a lot of these value drivers that we're discussing that are here, one that's up here on the screen is AR, aging. Well, hey, that's something you can actually change, and you can have your financial team get working on today to improve that value. And if you fix that, hey, you could drive, you change the slide on me, but whatever that number is, $85,000 in increased value by improving your day sales outstanding as an example. So there's just so many things like that when you look at that 2 to 5 year run, where you as the owner no longer have to be the guy pulling all the levers. Actually, how do I take these different drivers to my different team members and actually get them to be working on pulling these levers with me to help drive up that value?
That's great. A couple questions we'll take now from the audience, but just a couple quick notes. So Reed shared a little bit earlier, but there's the cost for Valuations as a service is a $2,500 one-time project initiation fee, and then a $700 a month subscription model. And we will waive the $2,500 project initiation fee for any 2-year contracts. And so again, we're talking about ROI being pretty straightforward on a tool like this, and our goal is to help you drive value as a company. John S. Wins. He chose the Cleveland Guardians. That is my favorite team. They got their 50th win last night. So John, be on the lookout for an email for that Amazon gift card. But we have time for 2 questions. And so let's talk about this one. We've talked about private equity a little bit and buyers a little bit. So this question says, I work for a private equity firm who's looking to make strategic acquisitions in the IT MSP space. Are buyers using this tool? And if so, how?
Yeah, we've got a couple of different or program probably specifically for the private equity space. The biggest challenge is there's so much misnomer out there around sellers. And so sellers will come to us and they read a report somewhere and says, I think I should get a 10x multiple on my 500,000 in EBITDA. I think that's what I'm worth. And you say, you as the buyer come along and say, no, you're only worth 5. They're like, yeah, I knew you'd say that because you're just trying to drive the price down. And so much of what actually gets into it, what we want to be able to do, and we do for a lot of our most strategic buyers and private equity partners that we work with is, hey, we'll come in as the neutral third party. We'll do the valuation. We'll manage the expectation. We've had, we oftentimes have sellers, we oftentimes have sellers who are like, hey, I'm not happy with the number, but they really can't argue with how we came up with the value. And so as we get through that whole piece, we're able to come in and be able to level set just the expectation of value through that whole journey. We split the valuation, or there's ways that we can offset the fees and split the fees between the parties so that we're able to maintain our neutrality. But in the end, for a lot of buyers, it's, hey, you're not afraid to pay a premium for the business. You just can't overpay for the business. And so much of what this is able to do for you is able to manage the expectations, position the expectations accordingly so that the buyer can still come in and actually pay a premium, and the seller recognize that a premium is actually being paid for their business based upon their company-specific risk factors.
That's great. Greg, last question for you. How does this tool differ from other tools in the marketplace, similar ones that provide access to dashboards and data around multiples?
Great question. And we do get that a lot because it's like, how many dashboards are really valuable if all of a sudden you have 10 different dashboards and telling you 10 different things. But I think the reality is that this truly is a different tool in comparison to other dashboards. No other dashboard truly measures value like the way that we measure value. It's not, like we said, more than a multiple. We're not just slapping an EBITDA multiple on your EBITDA and saying this is your approximate value. we're actually going through an income approach, present value of historical and future cash flows calculation, as well as coming up with a company specific risk factor that is specific to your company and where you're at in your operational maturity and the things that you have going on in your business, coupling that with our experience in transactions and what we're seeing in the marketplace, we actually then can apply a market approach methodology on top of that income approach to validate and vet out, are we actually within range of what we're actually seeing in the marketplace? So that type of valuation is a very thorough one versus just slapping a number on your EBITDA. In addition to that, giving you all those drivers, those are pretty different and more unique drivers when they're tied back to value versus maybe some of those other drivers, maybe around operational maturity or different things you might get on other tools. They might be specific to, best in class ways to run your business or best in class ways to offer services to customers, which, don't get me wrong, those are great tools for those purposes as well. But if your purpose is to go out and achieve a certain goal or objective for a personal wealth target, an exit strategy, whatever that may be, you're trying to keep that end game or that sale price in mind. This is really the only tool that truly measures that to a certain level of consistency and regularity with the marketplace.
Great, Reed, Greg, thank you so much for your time and the great insights. A couple of quick housekeeping notes as we wrap things up. So maybe you want to get into the nuts and bolts of S corps and C corps and LLCs. Oh my, right? So the alphabet soup of tax strategies and structures. If that's a Greg topic, Greg loves that topic, and we're doing another webinar next month, July 23rd, 2 Eastern, and we'll have a link out to register for that webinar within the next day or so. So keep that in mind. We do have a recording of this that will be sent to you probably within the next couple hours. And so if you missed maybe part of the webinar, you came in a little bit late, that's not a problem. You'll be able to catch up. And then John will make sure that you get that Amazon gift card for guessing that my favorite team is the Cleveland Guardians. So appreciate everyone's time today. Thank you for the gift of your time, for allowing us to speak a little bit. Reed, Greg, any closing thoughts before we wrap things up?
No, excited to be able to do this, excited to be able to bring this to the market, and just actually really looking forward to, as a quick side note, of the 10 companies that were in the beta group, 7 of them sold before a year went out. So we're not saying that that's going to happen for people that sign up, but one of the things that really drives so much of why we built this and why we went is we actually want to see businesses transform, and we want to see business transactions actually be a win for the buyer and a win for the seller. And so part of the thing we're passionate about on this is I think is a really first tool that really accomplished that, of going meaningful data so you can transform your business, actually change the outcomes in your life from a personal wealth target perspective. And then for buyers and sellers, really helping to manage the expectations so that there's a fair transaction. I think as we do so much transaction work, it's not so much that sellers really want to have get overpaid for their business. I mean, they want to make as much as they can. But in the end, most sellers are conscientious of the buyer, knowing that, hey, it's got to win for the buyer. And most buyers are willing to pay a premium, but they just don't want to overpay, and they want to make sure it's going to work for the seller. And it's always this rather contentious negotiation where, coming in with this tool, we're actually able to move to this place where finally we can help assure that there's a win for the buyer, a win for the seller, a win for the individual owner that actually wants to transform the business and actually make meaningful change in a real and systematic way. And so it flows so much out of the heart and the mission of who IT Valuations is, and we're really excited about it.
And the other thing I'll note with those 70% of our beta test group selling, we actually have over 50% of our current group that I would classify as more, and they would classify themselves more as buyers versus sellers utilizing the tool, where they're maybe post-merger or they're post-acquisition, or they're still doing acquisitions, or they're entering into a merger, and they're actually utilizing this tool to validate and measure their value creation from doing those transactions and doing the merger that they went through. And so just all that to say, this isn't just a tool if you're going to sell within the next 12 months to a year or to 5 years. This is a tool truly for any company, because tracking value creation is important for any business.
Well said, Greg. Reed, thanks so much again for your time. Everybody, we'll see you on July 23rd, if not before. iTvaluations.com for more information. Thanks so much, everybody. We'll see you soon.